I am delighted to introduce our first speaker of the day, Neel Kashkari, President and CEO of the Federal Reserve Bank of Minneapolis. Neel has been in and out of public service throughout his career. Many in the audience will remember that he served in the Treasury Department from 2006 to 2009, first as senior advisor to then Treasury Secretary Henry Paulson. Later, as Assistant Secretary of the Treasury, he established and led the Office of Financial Stability and oversaw the Troubled Assets Relief Program, or TARP as it's known, for Presidents Bush and Obama. Those years gave Neel a front-row perspective on financial regulation, and today he'll share some of his concerns about the current state of U.S. financial markets. His private sector career includes senior posts at PIMCO, Goldman Sachs, and TRW, where he was an aerospace engineer. After Neel's talk, CII Board Chair Ash Williams will join him for a short fireside chat. Neel, welcome to CII, and the screen is yours.
Thank you, Amy, for the introduction, and I really appreciate the opportunity to be with you today and to speak to the Council of Institutional Investors. As a reminder, my remarks reflect my own views and not necessarily those of others in the Federal Reserve System or on the Federal Open Market Committee. I also thank you for allowing us to record and replay my remarks, which is important for transparency. I'm excited to join you today because of who CII is. You are long-term investors who work on behalf of millions of Americans to secure their economic futures. With $4 trillion of assets under management, you are important stakeholders in our financial system. While there are other large players in our economy and our capital markets, few combine that scale with such a long-term perspective. You don't have the luxury of looking out only 1 or 2 quarters or even 1 or 2 years. You make decisions that will affect your members many years in the future and even over decades. It is your unique combination of scale and long investment horizon that is motivating me to speak with you today. I know from my own experience in government and in the private sector that CII and many of your members are active leaders in driving positive changes in our economy and our society. Take corporate governance as one example. You have long advocated for strong governance practices because, as you say on your website, and I quote, CII believes effective corporate governance and disclosure serve the best long-term interests of companies, share owners, and other stakeholders. Effective corporate governance helps companies achieve strategic goals and manage risks by ensuring that share owners can hold directors to account as their representatives, unquote. Another example, of course, is climate change. Several leading pension plans actively promote environmental sustainability by investing in companies that are aligned with their goals and principles. It seems to me that you take on issues that first are in your members' long-term interests. Second, that your scale and your role in our economy position you to help drive meaningful change. And third, that are the right things to do for society as a whole. Well, I want to speak with you today about another issue that I think meets that 3-part test and on which I believe you should focus your policy agenda. That is capital markets and banking regulation. I know this is not a new issue for you, as many of you have identified financial market stability as important to your ability to deliver for your members. However, I'm going to argue today that you should elevate this issue to the forefront of your agenda because large unacceptable risks remain, and you are uniquely situated to drive change. Your members and all Americans deserve a better financial system than we have today. Earlier in my career, I worked at the U.S. Treasury Department and oversaw the Troubled Assets Relief Program, or TARP, in the Bush and Obama administrations. I confess that that experience of battling the global financial crisis is burned into me. In the worst moments of the crisis, we did not know if our financial system, our banking system, and our broader economy would pull through. Looking back, I realized that our programs, Treasuries, the Feds, and Congress's fiscal programs, they were collectively effective in stabilizing the crisis. But I also know that we got lucky. We didn't know for sure that our programs would work. We were taking our best shot, and it could have been much worse. We saw that fragile capital markets and a fragile banking system can inflict enormous damage on the broader economy and on Main Street, on everyday Americans living their lives far from Wall Street. These are your members. Think back to 2008. What was happening to your pension plans? What was happening to their funding status? For most, if it was a catastrophe in the making, and even with the massive government intervention, many plans haven't fully recovered. The most recent data from the Federal Reserve shows that before the financial crisis, state and local pensions were about 66% funded. That fell to 48% in the crisis, and most recently, they had only recovered to about 52% funded. Beyond the pressure on pension plans, think about the hardships your members faced. Even with massive government intervention, millions of Americans lost their jobs. Many lost their homes. Many who were responsible and bought homes they could afford lost those homes after they lost their jobs. The financial crisis was deeply unfair in who paid the price for the risks that had built up in the financial sector. Following the financial crisis and Great Recession, Congress passed the Dodd-Frank Act, and new regulations were put in place to increase the resilience of the banking sector. That act and the reforms that followed were based on a fundamental design principle. Keep the basic architecture of our financial system unchanged. Just strengthen the existing structure, but don't be so aggressive that it leads to major changes. As a result, large banks were forced to increase their capital levels modestly and to fund themselves with longer-term liabilities. Stress tests were introduced. But the basic architecture and the main players didn't change. Did the reforms work? The largest banks in America do have higher capital levels than they had before the crisis, and they do fund themselves with less short-term borrowing. But the 10 largest bank holding companies in America are around 45% larger than they were going into 2008, having grown from roughly $9 trillion to nearly $13 trillion in assets. While banks often complain that regulations are hurting their competitiveness, the data show clearly that this is simply not true. When I joined the Minneapolis Fed in 2016, we embarked on a review of the issue of banks being too big to fail, to assess the reforms that had been implemented and whether more were needed. Our analysis, and that of many other independent researchers and academics since, confirms that large banks in America are still too big to fail, and their capital levels are not high enough to balance the benefits society gains from their scale with the risks that they pose to the economy. This analysis shows clearly that large banks should fund themselves with equity of at least 24% of risk-weighted assets, up from around 13% today. That would maximize the benefit to society and protect taxpayers, because at those levels, banks could cover their own losses. Now, banks make all sorts of arguments against higher capital requirements that are easily refuted. I'm going to give you three. First, they say that they will be at a competitive disadvantage if other countries don't follow suit. But that is already proven to be false, because US banks are out competing European banks that have even more lax regulations. Next, they say the US economy benefits from their large economies of scale, and that those will be lost if they are forced to issue more equity, because they might choose to break themselves up to get around the higher capital requirements. Well, if in fact they have such economies of scale, then they should be able to afford higher capital levels than small banks. Perversely, large banks on average have much lower levels of capital than small banks, even though small banks don't pose a systemic risk to our economy. It's the exact opposite of the way it should be. Finally, their favorite line is that lending will be curtailed if they have to fund themselves with more equity. But up until COVID-19 hit, they were buying back billions of dollars of their stock each year. In fact, combined, the 8 largest global banks headquartered in the United States bought back more than $110 billion of stock in 2019 alone. If capital was constraining lending, why were they buying back their stock? It's nonsense. Now, large banks will never address these risks on their own. Their management teams have a fiduciary duty to their shareholders, which are you and your members, to maximize shareholder value. And the shareholder value maximizing business strategy is for banks to expose the taxpayers to as much risk as possible and then count on the government to bail them out in bad times. More specifically, they are charged to run with as little equity as possible. That is how you maximize earnings per share. Large bank CEOs would not be doing their jobs for shareholders if they didn't fight back against regulations that could protect taxpayers and make the financial system safer. This is not hyperbole. This is the reality of our economic system and why they are willing to make such silly arguments that are so easily refuted. There are some risks in society like this. We call them externalities, which the private sector simply cannot address on its own. And that is why strong government regulation is necessary to address those risks. Congress considered financial system reform when it wrote the Dodd-Frank Act, and it chose not to be aggressive in reforming our financial system. Why not? I have asked that question of numerous members of Congress on both sides of the aisle. They respond simply that financial firms have enormous influence on Capitol Hill. Strong regulation is the textbook response to externalities such as pollution or too big to fail risks. However, that response fails if the regulated entities have too much political power, and unfortunately, that appears to be in the position we are in today. Before COVID-19, the good news, or so I thought, was that we had time. Prior to the Great Recession, the last time the United States had a systemic financial crisis was during the Great Depression. So I thought, well, if these massive shocks happen only every 80 years, then we can take our time to reform the system. And then COVID-19 hit us. Much to my surprise and horror, in March of this year, the financial system faced another systemic collapse as fear gripped markets and investors shunned most securities in favor of cash. Facing this crisis, the Federal Reserve stepped up forcefully to backstop the financial system, pumping trillions of dollars into markets and directly supporting money markets, municipal bond markets, mortgage markets, corporate bond markets, and the Treasury market. In 2020, the Fed acted much faster and more aggressively even than it did in 2008. I fully support the Fed's actions in responding to the COVID-19 crisis, but I just can't believe that it happened again, only 12 years later. And I keep asking myself, what kind of absurd financial system do we have that requires the central bank to bail it out every decade? How can it possibly be this fragile? So far, this financial crisis has been focused on funding markets, such as commercial paper and money markets, rather than on large banks. You might not realize it, but the banks got a lot of help. How have the tens of millions of Americans who lost their jobs because of COVID-19 been able to make their credit card payments, car payments, and rent and mortgage payments? Most have been able to make these payments because Congress acted so quickly and aggressively to send money to the American people, including the $1,200 one-time checks many Americans received and the extra $600 a week in unemployment benefits. Bank losses would have been much, much larger if the American people didn't have this extra money to make payments on their loans. I applaud Congress's bold actions to support people affected by the COVID-19 crisis. But we need to be clear that families were not the only beneficiaries. This was also a banking bailout. In my mind, the funding markets that almost collapsed in March raise important and complex policy questions. Unlike addressing the risks of too big to fail banks, where the solution is clear and straightforward, force them to fund themselves with more equity, the solution to fragile funding markets is less obvious but also important. Fundamentally, I wonder why we allow firms, financial or otherwise, to fund themselves overnight. What societal value is there in a system that prove so fragile when risks emerge. The primary value I see is that it allows firms to eke out a few extra basis points of earnings in good times, and then requires the central bank to backstop it when risks emerge. That is the definition of privatized profits and socialized losses. That strikes me as an absurd system for the country. We need to carefully study what happened in these markets in 2008 and again in 2020 to develop effective solutions. In my view, we cannot keep doing what we've been doing. I am not suggesting that we could eliminate all financial crises if we aggressively addressed these flaws in our banking and financial system. Crises have happened throughout financial history and no doubt will continue to happen in the future. I do believe that with smart, aggressive regulation, the American economy could thrive on an efficient, competitive, and innovative financial system that was more resilient against shocks, one that required taxpayers to step in far less often and at lower costs. So why am I coming to you today? Because you are uniquely positioned to drive much needed reforms in the banking sector and the broader financial markets that have proven so fragile. First, you are large bank shareholders. Bank management will argue they are just doing their jobs, simply trying to maximize shareholder value for you. But you are in a position to recognize that maximizing the value of one sector of your portfolio that then puts the rest of your portfolio at risk doesn't make sense. You are in a better position than most to understand the spillovers of these financial system risks, and you can demand change as shareholders. Second, you are huge players in the capital markets, which means you are important customers of large banks. If the largest pension plans in America got together and said, we are not going to trade with banks that do not have at least 24% equity, they would increase their capital levels. Banks are hard to change, but they know they have to listen to their clients because the marketplace is competitive. And if they don't listen to you, some of their competitors will. Don't underestimate your potential influence as major capital markets clients of large banks to demand and drive change. Finally, the bailouts worked in 2008, and they worked again so far in 2020. Will they work next time? Will there be political will to backstop the financial system the next time there is a massive shock, such as a real estate bust or another pandemic? I don't know. Will there even be the political will to continue to support Americans who've lost their jobs because of COVID-19? I hope so. Is betting on successful future bailouts a sensible risk for your members? I would argue the answer is a resounding no. I'm here today to ask you to put meaningful banking and financial system reform at the front of your agenda. I believe your members and the American people deserve a resilient financial system that doesn't require a bailout every decade or so. Fixing this system is absolutely in your members' long-term interest. Your scale and your role in the capital markets uniquely position you to help drive meaningful change, and it is clearly the right thing to do for society. We at the Minneapolis Fed would be pleased to work with you to share what we've learned, to examine these recent episodes, and to advance solutions that will finally address these risks. Thank you very much for having me today, and I look forward to the discussion with Ash and then with all of you.
Neel, thank you for your insights. You made a number of thought-provoking points. I took a look back at the history, and I know that since Dodd-Frank was passed in 2010, we've seen the erosion of some of its key elements, including the Consumer Finance Protection Bureau, Volcker and swaps rules, and bank asset thresholds for advanced prudential standards. Other parts have endured and evolved, like the Fed's comprehensive capital analysis and review evaluations. As you pointed out, net of these changes, swift and substantial central bank and backup fiscal policy interventions were required in response to the onset of the current pandemic, suggesting there's room for further reform. So a couple of follow-up questions, if I may. First of all, We're in a very low growth, a persistent low growth, low interest rate environment. How does that relate to bank safety, soundness, and prudent capitalization? And are there moral hazards that are worsened by this environment?
Well, thanks for the question. We are in a low interest rate environment, as evidenced by the latest FOMC statement, where we said we're going to keep rates low for the foreseeable future, essentially. The low interest rate environment is a function of the broader macroeconomy. The neutral rate is something that we think about a lot in central banking. What rate doesn't stimulate the economy but doesn't restrain it? And we think the neutral rate is low because there's a lot of savings in the global economy and there are less demands for investment capital. So our best estimate is that we're going to be in a low rate environment for quite a while. And one thing that means is that the traditional policy tool that central banks have of lowering interest rates in a recession, that is more limited than it was, say, 10 years ago or 20 years ago when interest rates, the neutral rate was much higher, and the Federal Reserve could cut interest rates 3, 4, 5% in a recession. So why is that relevant to financial stability? I think that means that if there is a shock, the Federal Reserve will have less ammunition than we've had in the past. And then it's even more critical that our banks are able to play the role that they play in getting credit through the economy. So one of the things that we think about a lot is when we move interest rates, the federal funds rate, we want to move interest rates across the economy, and the banking sector is a key channel by which our policy decisions get transmitted into the broader economy. So I think a low interest rate environment makes it even more important that our banking and financial system are sound and resilient because the traditional policy space of central banks is more limited.
Thank you. And an extension of the same concept would be that low interest rate environment makes the challenge of attaining the actuarial investment return assumptions of pension funds or meeting the spending requirements of endowments and foundations or the objectives of corporate CFOs all the more challenging to achieve. So how would you, and recognizing that many of CII's members, as you correctly point out, are also owners of the major publicly traded institutions around the world, how would you prioritize the need for regulatory reforms and reconcile those to the investment objectives from a fiduciary perspective if you were an asset owner?
I would say I completely understand the rate environment that you're experiencing, the return environment, the challenges that you've had. There are many sectors of the economy in which you could invest to find potentially attractive returns. All I'm suggesting is, hey, let's not make the financial system, by levering up the financial system, maybe you can boost your investment returns in that portion of the portfolio. But if that system goes down, it brings down the rest of your portfolio. If on the alternative, you invested, let's just say, take the tech bubble, for example. A lot of plans invested in tech stocks in the late 90s looking for attractive returns. When the tech bubble burst, it didn't bring down the whole US economy. We had a pretty mild recession in 2000, 2001. There was no systemic collapse even on the table. And so the financial system has these spillovers that can bring down the whole US economy. I would just respectfully say, why don't you seek your extra investment returns in the rest of your portfolio, and let's have the plumbing of the financial system and the plumbing of the US economy, let's have that be sound and resilient.
Got it. So there's a centrality and a systemic contagion issue in the financial sector that's far less so in any other sector of the markets. That makes sense. Thanks.
Exactly.
So let me go back to a comment you made earlier. The stresses that first appeared when the pandemic dawned were in funding markets, repo in particular, and as you pointed out, the central bank quite correctly stepped in very vigorously, very swiftly, backstopped those markets and calmed the anxiety that was rapidly emerging. Does this imply that we need some specific change in the policy or oversight of asset and liability matching in the way that's accomplished?
I think that's got to be part of it. I mean, we know for the history of time that short-term, runnable securities, you got these long-term liabilities and short-term assets, presents its own risks. It also serves an important role in society. I mean, there's a reason we have bank accounts, and there's a reason we go to banks to get mortgages, for example. So I'm not suggesting you eliminate all asset liability mismatches the way banks do, or the way banks inherently have. But just the tri-party repo market. I mean, the more I study the market, the more extraordinary complexity is there. And the more you start to see how fragile it is. As soon as people get scared, these markets just freeze up and then face a potential collapse. And I'm challenging us. I don't have the answer today to say what we do about these overnight markets that are proved so fragile. But I just would humbly say we can't keep doing what we've been doing. And people have put all sorts of proposals out there. You could tax them. You could have a transaction tax. There are different ways of regulating it just to try to get people thinking on a more long-term basis. I mean, if you're a corporate treasurer at a blue chip company, I know why you're participating in these markets, because you get a little extra margin. I get it. But if the cost of that to society is you've got this incredibly complex web that collapses when people get scared, I think it raises big fundamental questions.
Fair point. And there might even be treatments that are not purely regulatory, like things on the accounting standard side, valuation tiering and the capitalization required for different sorts of exposures. That would focus people's attention as well. So let's look at one more thing. To date, U.S. fiscal policy has largely masked the cumulative and ongoing effects of the pandemic on business and household earnings, employment, loan delinquencies, lease and mortgage defaults, state and local government revenues and balance sheets, et cetera. You alluded to the Payroll Protection Act and the $1,200 and $600 distributions that have been made to date. There seems to be a disconnect between the real economy and the financial market economy. Is it just me, or are these factors increasing systemic risk?
Well, I don't know if they're increasing systemic risk. I mean, I do think you were right in the premise of your question that much of the fiscal pain has been extinguished or deferred by Congress's fiscal actions to all of the parties that you just said. And so I guess the question is, if Congress does not come back together, then I think we'll be exposed to all of the risk that you just talked about. Think about the foreclosures that have been deferred, the people who have been able to make their rent payment, but may not be able to make it now if they don't get continued unemployment benefits, and all of those ripples through the economy. So I think Congress, I mean, I just think they've done an extraordinary job thus far in the pandemic, coming together and being very bold to support businesses, small businesses, and American workers who've been directly impacted by COVID-19. If that really is not going to continue, if this is it, then I do think the economy faces much larger risks. We've talked about in the past of a fiscal cliff, so to speak. I think you'll start to see these spillover effects. I mean, just here in Minneapolis, I've been surprised and saddened how many restaurants, blue chip, very successful restaurants in good times, how many restaurants have announced they're closing their doors for good. And that's with all of the government assistance that has been provided. If there's no more assistance to come and the pandemic is going to go on for another year or 18 months until a vaccine is widely available, then I would expect that there's going to be a lot more fiscal pain in the economy and a much stronger drag on the economy as a whole.
Right. Furloughs, transitioning determinations and such.
Exactly.
Right. Thank you. Why don't we go to Glenn and see if we have some audience questions?
Thank you, Ash. Our first question comes from Mike Garland of the New York City Comptroller's Office. What is the role that financial regulators can or should play in addressing any systemic financial risks posed by climate change?
Well, this is a good question. Something that a lot of my colleagues and I've thought about quite a bit. It's hard because if you look at the forecast horizon, you know, it's hard. If you look at the traditional forecast horizon of climate change, it's traditionally over decades. I say that recognizing what's happening in the West Coast right now. So one way of approaching this problem is to say, well, what are the systemic implications, for example, on banks and insurance companies that have exposure on the West Coast, potentially to forest fire and fire damage, or on the Gulf Coast to hurricanes, as an example. That, I think, that is easier to address because you can say, you can look at a given company, you can look at their portfolio, you can see their exposure, and you can run scenarios to see if they are resilient against those shocks. So that one I think is clear, and that is, I think that already should be, and to some degree is part of the regulatory process to look at banks and their portfolios and how they're accounting for risks. I think the broader question of systemic global climate change and how it's going to affect all businesses that are going to have to adapt to it, I think that is a much more complex question that I don't yet know how to address. So, for example, in Minnesota, we have, let's say, banks in Minnesota that we regulate that don't have much exposure to the coast, so say forest fire, or to the Gulf Coast, say hurricanes. How do we think about how climate change is going to affect them and the systemic risk that they face? It's a less direct connection, so it's less clear to me. I'm not saying it's not important. I'm just saying some of these are easier to do the analysis today. Some of them we have a lot more work to do.
Thank you. Our next question comes from Mark Hill of the UAW. With regard to recent CCAR reforms that are designed to make scenario analysis more efficient for financial institutions, are there any changes you would make to these reforms in light of COVID-19?
Well, there's a debate. There's a fundamental debate about CCAR and stress testing and how transparent you want to make them. On one hand, there's an argument that making them transparent it's good for accountability. It allows the public to see what the regulators are doing, and then it's fair to those regulated entities. There's another view that if you give them too much information, that they might game the tests. And I've heard anecdotally some evidence of this, that if banks know when they're going to be measured, they change their portfolios during the measurement period, and then they put the risk back on after the measurement period is over. I made an analogy, which some people didn't appreciate, that it felt a little bit like Volkswagen knew when their cars were in an emissions test, and they changed their engine behavior during the emissions test. And then when the test was over, they turned the full power back on. So for me, I think that stress testing is a really important tool to make sure that banks are resilient. And we should be tough, and we should surprise the banks. We should run tests that they're not thinking of. I'll tell you this, the most stringent stress test scenarios that we came up with a year ago paled in comparison to the shock we just hit at COVID-19. And everyone said, oh my gosh, the Fed stress tests are so unrealistic, they're overblown, it'll never happen that bad. And then here comes COVID-19. And the nature of shocks and the nature of crises is they're not just like the last one. They come when you're not expecting it, and they come in sizes that you haven't prepared for. So to me, stress testing and anything we can do to beef it up will make it a more useful tool.
Our next question comes from Keith Johnson of Reinhardt Law. Would the Fed or members of the governing committee as individuals be willing to speak out against the Department of Labor's proposal to silence shareholder voices by making it more risky and difficult for ERISA pension funds to vote proxies?
That's something that I'm not afraid to comment. I generally speak my mind about things. I don't know enough about it to offer a view. I mean, I've heard of it, but I have not studied it carefully to know what are the nuances on various sides of the issue. But I'll tell you this, I can't speak for anybody else at the Federal Reserve, but I will say that I will look at it. And if the organizers could connect us, I would be pleased to follow up with you once I've looked at that issue more carefully and give you a thoughtful response.
Great. Our next question comes from Michael McCauley of Florida SBA. Do you recommend any specific corporate governance practices at bank boards aimed at minimizing investor risk?
Well, I think when they're nominating new directors, I think asking them questions about what are their views on banking risks and banking systemic risk. It goes back to this fundamental, this is the gap that I talked about in my speech, right? Management are saying with a straight face, and they're right, that their job is to maximize shareholder value. But maximizing shareholder value, and if the board of directors is simply looking narrowly at our job is to maximize the value of these shares, that puts the rest of your portfolio at risk. And so this is a weird fuzzy area where the traditional corporate governance practices don't completely account for this. And this is why I talk about it. This is what we call an externality in policy circles. It's just like pollution, right? If you were on the board of directors of a manufacturer and nobody was looking, I wouldn't advise this. Polluting may well be in your shareholder value maximizing interest. That's why we have the EPA to say, no, that's not okay. You can't do that. And so I think that this is a complicated question. I know that I mean, I'm addressing you from a systemic risk perspective. I also think this is raising important questions from a fundamental corporate governance perspective, because again, if those directors are simply saying our jobs are to maximize the value of these shares, then that may not account for this risk that I'm talking about. By the way, that's true in climate change too. To those of you who think climate change is an important issue for you to consider, you could imagine a board of directors saying, well, we're not going to care about climate change. We just want to maximize our share price. And you're pushing back on them on that. I'm asking you to take that same broader perspective as you think about financial stability risks.
And we have a question about the possibility of another coronavirus relief package in Washington. Could you discuss in general terms your views on some of the key issues under debate, including whether and how much relief is actually needed, whether it should wait until after the election, and how much relief should go to state and local governments?
Well, I think those are complicated questions. I don't have clear answers. I'll tell you the components of it that I think are really important. I think getting money, continued money, into the hands of people who've lost their jobs is vitally important. You know, we hear people say, well, this extra $600 a week, that's a huge disincentive to work. That's true. When the unemployment rate is 5% and we're trying to get it down to 4 or 3.5 like it was in February, that extra $600 a month could be a big disincentive to work. But the unemployment rate is still near 9%. If you add up all the people who've left the labor market, it's probably closer to 12%, the effective unemployment rate. There are far fewer jobs in America than there are workers. So the moral hazard of the extra money, I'm not worried about right now. At some point it'll be an issue, but not right now. That is how we've kept up, as Ash and I talked about. People have made their credit card payments, their mortgage payments, their car payments. That's how consumer spending has been maintained. So the economy has been able to bounce back to the extent that it has. So I think continued benefits to people who've lost their jobs is vitally important. And I do think money to state and local governments is going to be very important because they can't run deficits and they employ a lot of people. And we want state healthcare workers to be working. We want teachers in the classroom. We want police and firefighters doing their jobs. And if state and local governments don't have a way of closing their funding gaps that came from this COVID crisis, they're going to be forced to lay off a lot of people, which is going to be bad for all the services that we're going to lose. And it's going to be bad for the economy as a whole. So for me, those two buckets are really important. And then third, whatever money we can put into vaccine development, testing development, therapeutics, $1 invested in shortening the duration of this crisis will pay itself back 10 times or 100 times in needing less financial assistance in shortening the crisis from another 18 months to another 17 months or another 12 months.
Thank you, Ash. We'll turn that back over to you.
Great, thanks. Neel, I just want to say thank you again for joining the CII today and sharing your wisdom and insights. We're very, very appreciative, and it's very clear to us that the president of the Minneapolis Fed not only gets the dual mandate and understands inflation and monetary policy and employment, more importantly, you understand what these things mean to American families, quality of life, and the fulfillment of human potential. Thank you so much.